Yep.
And Kate, did you see that I sent you that advisor agreement to share with everyone? Okay, great.
Yep, and I'll share. And Angel, thanks for your patience on getting back to that. I was a little.
Don't worry.
The last 2 days, but yes, I'm going to include that FAST agreement in tomorrow in the email as well. That was awesome.
All right. So does anyone have questions about last week, what we covered? Anything? Otherwise, we'll just jump into this one. Okay, so today we're going to talk about term sheets and financial statements. Now, when I say financial statements, that's from what to expect from founders when you're doing due diligence, and term sheets is more about investors as you looking at term sheet and understanding what's in it. All right, and then the next week we are going to do waterfall analysis on how to calculate your possible returns, etc. So this week and next week will be a little bit more of math and just understanding what's how to evaluate the company, as well as what happens when dilution, etc., etc. All right, so let's get started. Let Kate know if you guys have any questions, because I'm going to minimize the so I can't see you guys. So if you have a question, let Kate know or interrupt. All right, so let's get started. I can't believe we're in session 4. Excited to get to this point. So today's discussion, again, as I said, term sheets and financial statements. One is for you to look at as an investor, and one is for you to be curious about from founders as far as the financial statements go. Oops, sorry. So the term sheet makeup. So there are 4 areas or 4 things that I look at when I am, getting ready to invest. And the most of them are pretty cookie cutter, meaning they're same from one investment to the other. Especially as an angel investor, you are coming in early and you're writing a smaller check. So the negotiated term as an individual investor, individual angel investor, doesn't happen that often, but it's always good to understand what those terms are. It happens more if you are still an angel investor, but you're a part of a bigger angel group like Band of Angels. I'm part of Band of Angels. So when we, even though we are writing individual checks, but we are investing as an LLC, and a bigger check is going into the company, maybe as a group we have more leeway to negotiating some of the terms. So we'll talk about the actual capital structure of a term sheet, then the three term sheets that they're out there that you may have heard of or invested with, and are wondering what the different things are. And again, I have to tell you this, that I'm not a legal professional, so every term sheet you get, make sure that if you have questions, contact a legal professional. So Kate and I are just doing this from our experience, or having this conversation with you from our experience. All right, so first we will start with leading an investment round and not being a lead investor, right? So when you are a lead investor, right, you can negotiate the terms with founders, because you're also are probably one of the the investors who is contributing, writing a big check. There's a board seat possibility, and usually lead investors invest from 10 to 40% of the entire round, and then they go out and gather other people to come in the, they syndicate the deal with other investors, and then they bring the other people from other groups, or whatever, subject matter experts, into the deal if they it's their followers. They also conduct and prepare the due diligence documents. Guys, I may have to stop my video because I'm getting a lot of I'm not sure if you guys can hear me clearly.
Yes.
Jags, you seem clear from us. There
Yeah,
haven't been
very
any
clear.
skips.
Okay, is it okay if I stop my video? Would that bother anybody, just so we have a smoother transition? Okay, sounds good. And if
Nope.
when we have a conversation, I'll turn it on, but I'll stop the video for now. Okay, thank you. Okay, great. So the lead investor is usually, like I said, negotiates the term, has a possibility of a board seat, gathers, other angel investors or other investors for the round, and conducts and prepares the due diligence docs. As a non-lead investor, you are just writing a check based on the terms that are already presented to you. You don't really have any right to negotiate, or you can't negotiate as a non-lead most of the time. May or may not depend on the value they bring, meaning board seat, right? Non-leads don't get a board seat unless they bring a value added perspective for the founders. So even though they may not be a lead investor, they may be investor, but they also can ask for a board seat if they can, bring value to the company. And they always do their own due diligence. There are a lot of non-leads, they follow lead, and I don't recommend that, because you always have to do your due diligence, because you have your own unique thesis and your own unique requirements. You should always do bare minimum with every deal, even if you have all the documents provided to you by lead and it comes from a very reputable source. And we non-leads also, syndicate the deal with others, right? They bring others on the platform.
I have a quick question about this, because I think as an angel investor, it's impossible to conduct incredibly thorough due diligence. Like if everybody goes back to the previous session, it's a lot. Like if you do market analysis, you look at the founders, you look at their referrals, it's just so much that I don't know if anyone as an angel can really do all of that. And then when, I write small checks, like maybe 25K on average, I don't always know whether I'm entitled to seeing some of the leads due diligence. Where does the line, where do you draw the line? How much are they typically willing to share? Is it okay to reach out to the lead? What's the sort of code of conduct here? I just frankly don't know.
Yeah. So just because you write, this is my theory and my perspective and my practice. Just because I write small checks doesn't mean that I don't care to see what others have done or type of due diligence that others have done. So I always ask if there is already a due diligence packet, or in a data room, or whatever, whatever is out there, I'd like to see it, even if I'm a small investor. So I'm not shy about asking. So I think as far as the etiquette goes, I think it is absolutely okay for you to say, hey, would it be okay for you to share due diligence that you have conducted so far? In addition to that, when I say always do your own due diligence, yeah, there is a lot of stuff, right? And some of the stuff that you may not have access to, like founders may not be able to spend 10 hours with you if you're writing a $10,000 check or $25,000 check, versus if they are going to spend that much time with other investors who are bringing in a lot more, lot higher check. But I always ask, who are the other investors, and would it be okay for you as a founder to connect me with the other investors so I can learn the type of due diligence they have done? And I also make sure that I tell the founders, this is not, this is just to make sure that I'm not asking you the same questions others have already asked. So I think it's all totally okay to ask, no matter what your check size is. And then the second is, you can also still do your own due diligence, right? You can just do research on Google. You can do reference check on LinkedIn. The three areas that I always do reference check, even if I'm just doing, $2,000 in a syndicate, because it's my $2,000, right? I always look up the founders on LinkedIn and see who knows them in my my circle of my sphere of influence. I also always Google them to see if there's anything that's out there article wise or any kind of thing out there that I should, I would like to know. And the second I do is I always look at the valuation. How did they come up with the valuation? So I want to understand, even if I don't get a chance to talk to somebody, I always talk to somebody else who is an investor saying that I'm looking at this deal. This is what the valuation is. What are your thoughts, right? So I either go with the investors who are investing in this round with the founder, or I connect with other investors. And then the third thing is I always, go back to my own thesis saying, do I have success with this type of founders or this type of product, or do I know of anybody who's had success? So they're different. So the last week we covered a lot in the due diligence, but that was it was a lot. Like it was like do market sizing and this and that. But in addition to all that, there is some things that I always do, even though I'm writing a small check. And the other stuff that we talked about last week, I depend on people who may have done a deeper due diligence in those areas, if that makes sense.
Yeah, no, I think that makes perfect sense. And like, that's how I would like to do it as well. Like, like just having like something to look at and then, go deeper in the areas that I want to know more about. In terms of your sort of experience, how willing are the lead investors typically to share this due diligence? Because for instance, when we talked to or heard from Minda last week, like she was like, oh, all of a sudden nobody wants to share their stuff, like when it comes to the VC world and so forth. I've had varying success. So I'm just like curious to hear from you.
I think I want to distinguish what Minda said. Minda said that the LPs are not ready to share their deck. But but when you ask a lead investor to share it, because they want to fill the round, right?
Yeah,
so they're very interested in letting you see the due diligence. So I think I've had more success almost all the time asking for the due diligence docs from a lead because they're interested in bringing investors into the round. I think what Minda was referring was the LP sharing their thesis and how they're raising and what their value proposition is for this fund, if I'm correct.
Yeah.
Yeah, Kirsty, one thing I would just add to that is, and Jag sort of mentioned this, but one of the ways that I always do this, both with angel investments and with our fund, is if you go through the founder, that if you're feeling there might be hesitancy from a lead investor, especially if you're an angel who might be writing out a smaller check to share full due diligence, if you go through the founder, that oftentimes will be kind of a nice boost to kind of opening the door. Like, listen, I would like this person in. Could you please talk to her? She would love to do some due diligence. I also like that too, because I never like back channels with founders. So from a transparency perspective, they usually appreciate that. So.
And also in a way, founder has to know because they are the ones who's telling you, who's leading the the term sheet, right? That's not a public information as far as I know, right? So you ask them who's leading the round and then would you be okay? So I think they are interested in filling the round. So they would be more than willing to help you.
Yeah, thank you. That answered the question.
Right.
One quick question, like obviously if you see, if you make one call to somebody you really, really trust and they say, absolutely, you should do this, sometimes that might be your due diligence done right there. But do you have any guidelines that you personally use in terms of the amount of time that you invest in due diligence? Because you could do DD forever and it's, not gonna really,
And that's a great question, Angel, because you know what? A lot of founders, I've known that, I don't want so-and-so person to lead because they go into analysis paralysis. That's what their reputation is, right? As a lead investor. Or I don't want this particular investor because I need to fill the round pretty quick. And historically, this person takes on way too long to do the due diligence. So, amount of time you spend on due diligence, right? You as an angel investor, it all depends on how much time you have. Are you working full time? Are you not? And that's why communities like this help, right? So you can bounce off ideas from each other, just as deal sourcing, also due diligence. I personally spend, let's say, I spend about 25 to 30 hours a week doing, just looking at decks, working with founders, and also working with investors. Due diligence, if I was given a company, and I can share this information with you later on. For example, Made in Space is a syndicate that I and Grant did through Venture University, and we were the lead investor, and we spent ton of time doing due diligence on that. And we created like a 40 slides deck, which almost had all the questions that a potential investor would like to answer, but that would like to have an answer to. But that was also because it was space. I didn't have any previous network or previous experience. That was my first space deal. So I spent a little bit more time on that, but also founder kind of also says, look, I don't have that much time. I need to do X, Y, Z, and in order to get the money and start running my business. So I don't know if I'm answering your question directly, but I sometimes trust what people who are subject matter expert or know a little more about the area than I do. I always go to them first if I don't know the space that well. And then the second is I always look at the due diligence that's already done. And then the three things that I shared earlier, I do no matter what. Did that answer your question, Angel?
Yeah, thank you.
Okay. Oh, and then there is also party round, right? Party round is nobody's no lead investors. It's such a hard deal that it gets oversubscribed, and founder sets the term. Founder is going to say, okay, this is what the company is valued at. Take it or leave it. I've got plenty of people, and most people who fall into this round are the previous successful founders, or a founder with a really hard name as an investor. So if I have a startup and A16Z says, oh, I'm going to take half the round, they are actually coming in as a lead investor for sure, but the other half the round, even though you like, oh, can I let you know in 2 months? No, it's like take it or leave it kind of terms. So that's called a party round. That's the okay. So then let's just talk about a capital structure, right? So in every company, there is a seniority and a rate of return. So seniority is the debt, like a loan, or debt where it's equity. It's not tied to direct equity. It's a loan, so they get paid first no matter what, right? So senior debt, you can look at that as a first mortgage, and the subordinate debt is like a secondary mortgage. So they are the first to be paid, and then they have a low risk and low return because they have a set percentage interest that they're getting. And as you go down the ladder, most of the investors fall into preferred equity. There are times that some investors want to convert preferred equity and into common equity to get more rights, more information rights, more more into what's happening in the company, a better view into what's happening into the company. They are the last to be paid. So the founders are in the employee stock option pool. They are all in common equity. They get the highest return, and also the risk is high because they're at the bottom. And we'll go through some of this calculation later on. And the preferred equity is where we have most of the investors, and there we have terms like liquidation preference and pro rata rights, and et cetera, et cetera. We'll go through all that in following slides. So let's talk about a convertible debt, right? What exactly is a convertible debt or convertible note? So the three areas that we are going to talk about today are convertible note, safe note, and priced equity. So convertible note is made up of this following information. They have a valuation cap. I know sometimes it's an uncapped note, and I never invest in an uncapped note. I have done it once and I've learned my lesson. And so my thesis now strongly says, I need to have a valuation cap. So the valuation cap, what it means is it's the maximum pre-money valuation the note will get converted to in the next equity round, where the new investors will invest at a higher valuation. So 5 million is where I feel comfortable having a cap. Lower the better, but I don't go more than 5 or 6 or $10 million cap. I've never actually come across a convertible note with the $8 or $10 million cap. Then the next component to the convertible note is the discount rate. So the discount rate actually applies to the note. When it gets converted, you get a 20%, 20% is a norm, 20% of less share value relative to the new investor in the current round. So for example, in the current round, per share value is $5, then your per share value is 20% discounted to $4 per share.
Jags?
Yes.
Sorry, just before you go on, one step prior to the pieces of a convertible debt note, could you just quickly, really high level, explain what a convertible debt note is, how it transfers into equity, just really quickly, high level?
Yeah, so that's where we are going. So convertible note is actually a promise that in 12 to 18 months, this note will get converted into priced equity. And when it gets converted, I am not going to go above a certain valuation cap. So let's say that in 18 months, you can't tell me that the company is worth $40 million because it is capped. The maximum value it can have is $5 million in this case, in our example. And when it gets converted, the discount rate and the interest also applies to that conversion. So the discount rate we talked about is, you're basically getting a discount when you're getting converted into a share. So instead of your share value being, let's example, $5 for new investor, your share value, you're getting converted at $4 a share. And the interest is like, for example, 6% interest is normal. So let's say that you invested $100,000, right? And using this convertible note, and you're supposed to get 6% interest at the end of the note maturity date. So you would convert into $106,000. Now you're not going to get a check for $6,000, but you will get an equity as if you invested $106,000, not $100,000. And of course, it has a maturity date because it's a note. So it's like a mortgage, right? When you get a 30-year mortgage, it has a maturity date. And you're getting a 30-year mortgage at certain interest rate. And if you have a good credit, then you may get some discount. And if you do adjustable rate mortgage, then you know that your interest rate is not going to go higher than certain percentage. So that's like a cap. I hope I made a good analogy or example. Was that helpful?
Yeah.
Okay.
Yes. Thanks, Jack.
Okay, sure. And also like the qualified financing, right? So that's where is the that's the term that's also used when describing a convertible note, qualified finance. So the minimum amount of capital the next round has to be to qualify the note to be converted into equity pre-money. What does that mean? That means that the in our example, we're looking at the valuation cap of $5 million, right? So the minimum amount of capital or valuation, the next round, it has to be 5 million or higher. It cannot be lower than 5 million. Then we are looking at a down round. So, I mean, that can also happen, and it has happened, but that's what the qualified financing means, that if this event occurs, then we are getting converted into equity. So then the next section is conversion. And I wrote all this down because, not because I can read it to you guys, but also it gets really twisted in my mind. So that's why I wrote all this down, so I can explain it to you guys. But I hope that is also helpful, the definition. So there are three main types of conversion terms, right? So prematurity. Of course, if the company is doing really good and they made all their milestones at any point prior to maturity, and the maturity is usually 12 to 18 months or 2 years, right? Before that, you can always convert the note. You don't have to wait until the maturity date, but you have to honor the valuation cap and discount and the interest. So it's like paying off the loan. You can always pay the loan off early, right? So at any point prior to maturity, you can convert the note into the price, into the equity with the terms that you agreed. Or if the company completes qualified financing prior to maturity, then it gets converted into, equity. It automatically gets converted. So for example, it's an 18 months maturity date, and I am fundraising as a founder, at a 12-month mark, and I think it's going to take me 6 months to raise my Series A, which then will convert into the priced round, but it gets all financing, my round is filled, and it gets converted in 3 months. I mean, it gets filled in 3 months instead of 6 months. So again, it can also automatically convert into equity if that event occurs. And also, the last point I'm trying to, okay. And also, it also gets post-maturity. Let's say that the date came and there is no qualified financing up, and nobody is we're raising a Series A round, but we are not able to close the round, right? So either you do, and you can either convert at a new valuation, because what's the reason it's not getting filled? Maybe it's overvalued, right? So you actually can either convert it at a new valuation, or have an option to convert at a predetermined valuation, which is 5 million, or you could also just sign an extension saying, okay, this note will, even though it's maturing in 18 months, we are at 18 months, we are going to give another 6 months extension. And that has happened as well. Like COVID times, right? If the entrepreneur needs more time because of what's happening with the things that are outside of his control, then you sign an extension.
So Jags, I was going to ask about the maturity date and if it went past the 18 months. And from what you just said, it sounds like there is incremental value that you can get out of that because they didn't meet the timeline. Is that correct?
It's not guaranteed. You can, or it depends on what the company is doing. If the company is doing really good, you are getting still the cap is 5 million, but the valuation, the longer they wait, the valuation is going to be higher, right? But so the Series A, for example, can be valued at 10 million, but what you have invested has a cap of 5 million. So
what if the company is not doing so well, and the reason that the maturity date is past the 18 months is because they haven't hit some milestones? They just need, to your point, they need more time.
Right. So if the company is not doing good, right, then you have three options. You can either demand your money, right? And most of the time, if the company is not doing good, they don't have money to give you.
Yeah.
So then you lose the money, or you ask, you sign an extension that will give you this much more time at the old terms, or you can say that, or the founder can say that, okay, we are doing the down round. So the note extension or addendum or whatever that is going to have a different valuation cap, because that's going to help us raise, that's what, let's say that $5 million is the cap, right? And the company is trying to raise Series A and it's not successful because it just doesn't make sense. So they may have to lower and say, okay, we are going to raise money at $4 million just to get that extra influx of money. So you have to, you have an option to convert at a predetermined valuation, which doesn't make sense, or at a new valuation.
Okay.
I know
Thank
it's a lot here, so take a little bit of time, and if you want to digest this or have other questions.
I have just a quick question, because from my experience, the maturity date is somewhat of a, it's pretty like, okay, it happens, and then I don't know what is the sort of once again, like the code of conduct here, that like, is the company supposed to reach out to all investors? Is it like the investor's responsibility?
Yes,
Like,
it's
the lead investor who renegotiates it for everyone? Like,
so there is no lead investor, right? Unless there is a Series A happening, and then the lead investor will reach out to all the existing investors, or the founder will, and say, this is what the new terms are, this is the date we are going to convert it. And those things happen all in happy situation, right?
well, I mean, like, if it's like a seed round or pre-seed round, and there has been like a lead for that round, and everybody is in the same boat with the maturity date like approaching.
Okay, I see. I think if you are an individual on a cap table, it is your responsibility to just stay in the know-how of where the company is, and you can always stay in touch with a lead investor and just say, hey, I know this maturity date is approaching, and if hopefully you had a founder sending you updates on where the company is and what it's doing, so you have a pretty good idea. And it's not just, okay, you wrote a check and 18 months down the road, you haven't heard anything, right? So that's not the kind of investors we want to be anyways. So I would suggest, if there is a lead investor, stay in touch with them. Maturity date is a post in the ground, and it is important because that's when we hope early stage investors to get into a priced equity round. And if there is no lead investor, stay in touch with the founders, ask them for the updates. And as long as you are an individual person on the cap table, you have responsibility to yourself to just make sure that you are aware of when things are happening and what you need. And etiquette around there is, I think, always ask. And obviously, Kirsty, I know you're not going to be a jerk about it, but if there are people like, hey, I haven't heard anything from you. So it's not like you wake up 18 months down the road and you send that nasty email. It's just like, okay, what's going on? It's coming up. How are you doing? So I think I'm just rambling at this point, but
I have a question for you.
Sure.
Is it common for a non-lead investor to kind of say, hey, I'm out, and other investors, including the lead, are not in alignment with that?
When you say I'm out, what do you
or
mean?
If they just, like understanding that the company probably, if you want your money back because it didn't convert, they probably can't pay you back, or that would be a challenge. But has that ever happened? And do you generally stay aligned with where the other investors are?
It all depends how much you have invested in the company, right? So if you have, invested in this company and invested a large amount of money. And remember, angel investment is a very high risk thing, right? Most of the time you will lose your capital, at least 50 to 60% of the time. So yeah, it does happen more often than not. What I have personally done is that if I'm not getting any money, I'm not saying that, you know, I'm out. Then I'm trying to figure out how can I help the founder? How can I
Yeah.
create, you know, a support system for the founder? Because the founder wants to also be successful, right? It's not like no founder goes into a company saying, yeah, I'm just going to have fun for 18 months and see what happens, right?
I would
So-
think that that could really affect your reputation as an investor if you don't stay involved.
I think we are definitely. So I'll give you an example. The company that got acquired, right, last week that I told you, and one of the investor was really unhappy. He's like, no, I expected more. What am I going to tell my company, my investors? So he was running an angel group, and he had several investors investing in this deal as a syndicate. I am an individual investor in this company. You know, it could have been, you know, it would have been great if it was 3x, but I was happy with 2x in, you know, less than 24 months. But the other guy is extremely unhappy in saying that I'm not even going to sign the DocuSign that you send to that will make the transition to the new company, you know, acquisition more seamless. And so I talked to him and I'm like, okay, great. I mean, I know you're disappointed, but the first thing about this space is you wrote a check knowing that you could lose all the money. So that didn't happen. So that's a great thing. Second thing you thought was going to happen was you're going to get 3x or 4x, and you, in your opinion, thought founders should have kept at it and try to find a better, better acquisition term. Well, that didn't happen because this is a pre-Series A company, and founder is a solo founder, and owns most of the company and has rights to do what he wants to do at this point because it's still not a priced round. So the third option is you sign it, you take the money, and then you just move forward. And then I talked to the founder at the same time, and he's like, I have a reason for that, doing this. And I'm never going to approach him ever for any investment money. I'm going to create companies. This is his second or third company. And he's like, I'm never going to have that investor as part of I'm not even going to go to him anymore. So yeah, the reputation does get affected on how you either support or not support the founder. Was that helpful? All right. So ready to move forward? SAFE. Why do founders love SAFE? Founders love SAFE. SAFE is a simple agreement for future equity. It was created by Y Combinator, mainly to lower the legal cost. So the convertible note and SAFE were mainly founder friendly, and also it doesn't cost that much to have these instruments and start raising. So SAFE is has these components. It has a valuation cap, but it also may not have a valuation cap. I made a mistake there, and I really want to make sure that you guys always make sure there is a valuation cap, because that's in my thesis now very strongly. Discount rate usually is there, or is, most of the SAFE I signed, discount rate is like minimal, like 5%, or even not there. There is no interest. There is no maturity date. And the minimum amount of capital the next round has to be to qualify the SAFE to be converted into equity post money. So that's the difference between the convertible note is pre-money and the SAFE is post-money. So for example, if you're raising $5 million, you're raising, you signed the note, SAFE note as $5 million cap, right? And you're now doing Series A, and you're raising, let's say another $5 million at, so there would be 20%. So there will be about $25 million. The valuation of the company will be $25 million, right? So $25 million post money. So they're raising 5 million and the SAFE gets converted at 25 million post money. So they're actually raising, the pre-raising, the value of the company they're raising at is 20 million, and the post money, because they're raising 20% of the company, it's 25 million, and the SAFE gets converted at 25 million valuation. While in convertible note, it would be converted at 20 million pre-money. That's the difference. Is that clear? I'm sorry, I can't see you guys, so.
Jags, yeah,
No, it's not.
Okay. All right.
Jags, what could be helpful, Jags, is if there was a way that you could qualitatively explain the difference between pre-money and post-money.
Yes, I have that a little bit later in the slide.
Because it's hard to what. Oh, okay. If we're going to address it a little bit later, that's great, because I think trying to attach it to numbers in our brains right now might be the difference.
Sorry, yeah, I have it. So maybe, I just wanted to give you like the definition of this, and then we'll look at the math. But the post money usually means that it includes the amount you have raised, and the pre-money usually means that it does not include the amount you have raised. That's all. That's the definition, but we'll go through it. Okay. So again, this is definition. We will go through this, and if we don't go through it, we can talk about it a little bit later. So the priced equity round, again, it has the value of the company, and we are getting converted at preferred equity. So if you look at the slide that I had with the capital structure, where the preferred equity class is higher than the common equity, so we get converted as investor at a preferred equity. That means that we get paid before the founders get paid. Then we have pro rata right. There are 3 kinds of pro rata right. No pro rata right, or you maintain the percentage you have. So for example, if I invested $50,000 in a $5 million convertible note, I own 1% of the company, right? When that $5 million convertible note gets converted in the priced equity round to $10 million, now my dilution, what I own as an investor is now 50% of what I owned before, which is half a percentage. So if I have a pro rata right, I could put in additional money to bring my the investment percentage back to 1%. That's what pro rata right means, maintain. Or the third, which never happens, is put as much as you want. You want to increase your price, your investment percentage from 1% to 10%, go ahead. And it doesn't usually happen. And also in this round, there is like a board composition gets, what information rights you have, and the founder vesting starts. So founder vesting is 4-year with 1-year cliff. So when the convertible note or SAFE gets converted into the priced equity round, we don't vest 100% of the founder shares right away, because then they will leave the company the next day, right? We don't want that. We want them to be there and grow the company. So founder vesting, the usual term is 4-year with 1-year cliff. What it means is the first year they don't get vested, and after that they get vested every month for a total of 4 years. And also the employee option pool gets created. And this is also really tricky because as investors, somebody who is going to get converted from convertible note to priced equity round, we want the post-money employee option pool. Then we don't get diluted. If it's a pre-money employee option pool, then we get diluted along with the founders. And we'll go through this a little bit more. I'm seeing everybody.
What is the if you looked at, you said there were safes, there were the convertible notes. What's the percentage of price equity round in terms of the deals that you've participated in?
So in most of the time, the stage that we are investing or we are talking about investing in, we are going to invest at a convertible or a safe note. Okay. What percentage of them actually get converted into priced equity round? That is a big question for me, is like, how many of my startups are successful at raising Series A? Because then I get converted into the priced equity round.
Okay, so it's a movement up the scale with regard to the valuation and the success of the startup.
Yeah, and having said this, that doesn't mean that startups can't start out at priced equity round, and we all prefer that. But most startups don't, because they're still trying to test the market. They're still trying to, there's a lot more work, expenses associated with priced equity round than it is with convertible note and a safe.
And what if there's like, it says 4 year with 1 year cliff. What if from a governance standpoint, the co-founder leaves after 2 years?
Then they get vested at 2 year mark. So if they are there for 2 years.
Got it. Okay.
It takes 4 years to be fully vested.
They leave the other on the table, whatever's left for the remaining 2 years.
Right. Okay. And also remember, when the priced equity round, if founder has, founder's side of the investment gets converted, has this 4 year with 1 year cliff. But they also get to participate in an employee option plan. So they're double dipping too. You know what I'm saying? So because now they're employees, not they're founders, but they're also employees. So there are also terms related to that. If founders are going to be taking money out of options from the employee option pool. So it gets more complicated at priced equity round. That's why most founders in the beginning go with in convertible note or safe. Convertible note is more investor friendly than safe. Safe is more founder friendly. Okay. May not apply to angel investors, but there's a common equity, which is the founder equity, preferred equity, which is the the investor equity. Then there's also convertible preferred equity, which converts preferred stock to common stock. Because if you are if you hold a large percentage of the company, and then you want to have more say in what's happening. So a lot of times, like VCs, like the last item is convertible participating preferred equity. Most VCs want that so they can control more of the company. And then there's a participating preferred equity, which is, I don't think we have to worry about this. I don't want to overwhelm you guys, but just know these terms post-priced equity round. But the level we are investing in is mostly convertible note and safe. And I'm happy to go over this if anybody wants to have a one-off conversation on what exactly these mean and how do they apply. Right now, they don't apply to us as much. All right, so here is the valuation ownership analysis, right? So what are some of the things that I am looking at, right? So let's go one at a time. And I think this should, probably explain some of the things we were talking about earlier. And if it doesn't, please feel free to ask. Okay, so what exactly is evaluation? Right? So valuation is not too high, not too low. Investors sometimes determine the valuation. We went over that. Lead investor, if there is a lead investor, if there's not a lead investor, then the founders, but it's good to have a lead investor setting the terms. And most of the time we are planning on 2 to 3 rounds before an exit, right? So we are saying we come in as a convertible note, Series A, Series B, and around Series B, Series C, either angels get pushed out or the company gets acquired, or some angels decide to, liquidate half of it and they leave the other half on the table. So that's something also that happens in the later stage rounds. Too much capital raise is not always a good thing. And we also know why, right? Because more money you raise early on at a lower valuation, more of your company you're giving away. And then the terms, the current round terms are usually based on the results from the previous round. And that when you are looking at the term sheet, you always want to ask these questions. What were the results from the previous round? And how are these terms, relatively speaking, where do they stand? If you are a new investor coming into the priced round. Question?
What's your longevity and planned term? Like you talk about plan on 2 to 3 rounds before exit would be ideal. What are you on average seeing that, that term to be from beginning angel investment to getting out?
Oh, you mean the number of rounds or
I'm just looking for a time frame. I mean, we had talked about, I think, in one of the sessions, 10 years, but I'm just trying to equate the time frame from initial investment through the chain up the rounds and this 2 to 3 rounds before exit, just trying to put it together to get some guidelines.
Yeah, no, great question. Sorry, I didn't understand. So my, the number of years, I think it's about 5 to 7 for 2 to 3 rounds to happen, company to go up to Series C, Series B, Series C, sometimes longer. And that's why also VC firms are much longer, like probably Kate's fund, 10 years, right? 10 years is a normal life cycle of a fund, because on average, most people exit around 7 to 10 year time frame. And VCs also want to stay in the game for much longer than the angels. So VCs are about 10 years, angels are about 5 to 7 years. That's what I have seen.
Okay, thank you.
Okay, let's talk about liquidation preference. Now, this is also going to be a tongue-tied. So let me go here first, and then I'll go back up, okay? So I skipped a slide on liquidation preference, but let me just go to the pre-money valuation and post-money. So I think this is the slide I told Kate that we have. So let's talk about this. So did I have a... 1 second. Yeah, okay. So let's say the pre-money valuation of the company, right? The pre-money valuation is 5 million. Pre-money meaning before you bring in the new money. What is the value of the company before you start in, getting the money in from the investment on this round? So in this example, pre-money is $5 million valuation. Investment in this round is 1 million. So the new money that's coming in is about 20%. And then the post-money valuation is 6 million. 5 plus 1 is 6. So as an investor, right, the investor ownership, the 1 million that comes in, post-money is 6 million. So the percentage of ownership for the new money is not 20%, it's 16.67%. Did everyone get that? So see, the investor ownership, if you were to invest in this round, where the pre-money valuation is 5 million, investment in this round coming in is at 1 million, the post-money valuation is 6 million. So the investor, let's say that I invested the entire 1 million. So my investment in this round is 1 million, and my percentage of ownership is calculated based on post-money. So 1 divided by 6. And then the share price also, like share price is pre-money divided by total of number of outstanding shares. So in this case, let's say there was a, it's a $1 a share, right? So 5 million divided by 5 million shares is equal to our share price is 1 million. And with the investment of 1 million, we have total of 6 million shares. So at a share price of $1, the total ownership of new investment round is 16.67%. So that's another way you can calculate the percent ownership. Questions? Okay. So now I'm going to go back to, let me just go back. I'll go here. I'm going to go forward and then I'll come back for liquidation preference. So everyone gets diluted after each capital raise. So if company raises again $1 million and gives away 16.67% equity to new investor, all previous equity holders are diluted by 16.67%. So for example, if I own 10% of the company before this round, now I own 8.33% of the company because I'm diluted by 16.67%. This may help. So I put together a spreadsheet and I copied it here. But let's say that pre versus post money valuation and dilution, right? So on the seed round, so I have like seed round, series A, series B, series C. So seed round, the pre-money valuation is at 4 million. Seed investment was 1 million. And then the post-money valuation is 5 million. 4 plus 1 equals 5. And at that point, seed investors owned 20% of the company, and then the founders owned 80% of the company. And the total is 100%. So in the seed round, 100% of the company was owned by seed investors and founders for the valuation of 5 million. Now in Series A, the same company, the pre-money valuation is $8 million because the company has grown. And now instead of $5 million, the valuation of the company is $8 million. And the Series A, we are raising $2 million. So the post-money valuation is 10 million. What happens to the founders? So we have new set of investors, Series A investors. They're saying that they're owning 20% of the company because 20% of $10 million is $2 million. So 20% of the company is owned by new investors. So my seed investor ownership now is reduced to 16% and to 64% as a founder and co-ownership, co-founders. Do you guys get that? Questions?
Yes. Is any of the limits that you talked about before, would that have helped at all with dilution?
What do you mean?
I mean, you talked about some limits with regard to, Yeah, with regard to the debt and where you are in the capital
Oh,
structure.
yes, yes. Oh, convertible note cap and stuff. Yes, of course. So in the seed round, let's say this was a convertible note, right? So the
Yes.
in the cap is I have not put that into this, but obviously
Okay, good. I understand now. At least I understand I'm in the right direction.
yes. No, this was just to understand on how to calculate pre-money and post-money
math.
dilution
Perfect.
as
The
it
math.
happened.
Got it.
Yeah. And then series B.
Hey, Jags.
Yes.
I was sorry to interrupt you. I was actually just going to ask, is a spreadsheet that people could play around with, do you have one that we could share with the group where they could actually sort of...
It's hard coded. I'm not so Excel savvy. So I've actually calculated in calculator and I put it in here. But I can ask around if somebody has it.
I see. If you felt there was, you're awesome. I love that. If you felt like there was a place where we could get something that the group can play around with, I think that would be awesome, but only if you think it would be easy.
Yeah, no, I can definitely even, I can definitely do that. All I need is just a little bit of time. I just need to put these equations in here and then I can send that. But give me a week, okay?
You got it.
That's okay. Yeah.
Yep.
Yeah. All right. So then you move to series B. Same thing. The company has grown from 8 million or not 8 million, $10 million from series A valuation to $16 million. This should say series B investment. Sorry, I have like so many typo and stuff. I apologize. So this in series B is a series B investment. So new money that's coming in is $4 million. So the post money is 20 million. So now that we have, under the dilution column, series B investor ownership, they are putting in 20% of $20 million, which is $4 million. So they are set at $20 million investment, the percentage. But then again, everybody else before that gets diluted as well. Sorry. And so on. So now in this spreadsheet, we are not looking at the discount or the interest or the liquidation preference or pro rata right. In this spreadsheet, all I want you to be comfortable with is pre-money, post-money, and how does it dilute your ownership. Okay.
Which I guess is the reason why you're saying to try and get as many protections up front, because if you look at the end of Series C, the seed investors, which I assume are a group, some angel investors, are ending up with the, and the founders with the biggest hit in terms of their ownership, right?
Right. We all get diluted by equal percentage. It's just that if you own a smaller pie, a smaller percentage of a pie before, you are still going to own the smaller percentage of pie. Unless if I have a pro rata right, then I can say I want to maintain in Series C. I don't know. Also, you have to figure out how many rounds in the future you have pro rata right. So for example, if you have pro rata right in the first 2 rounds, then you can do Series A and Series B. So if you look at the Series A column and you have a pro rata right of, you have a pro rata right, then in order for you to maintain your 20% equity, and you'll have to put 4% of the investment, which is about 400,000 more. And in order for your pro rata to maintain, right, to maintain the same percentage, as you go through the future round, more expensive it gets. And that's one of the other reasons why angel investors don't do pro rata right after one or maximum of 2 rounds, because why, I would rather invest in something else that is lower valuation instead of spending so big chunk of money trying to maintain my percentage. That makes sense? I hope so. All right, so now let's go to the liquidation preference, okay? Okay, no, we'll go to pro rata. So pro rata isn't, we talked about that. Investment amount in the following round to maintain current percentage of ownership. So if investor currently owns 10%, next round is 1 million, then pro rata is 100,000 in order for him 10% of 1 million. If he invests this amount, the ownership will remain the same. If you go above pro rata, increases the percentage of ownership. Below pro rata, decreases the percentage of ownership. Okay, so before we go to the financial statements, which should not take that long, let's go to the liquidation preference. This is the slide I skipped earlier. So liquidation preference is also really important in a term sheet, right? What it means that if there is an exit, whether it's a, any exit event, acquisition, IPO, bankruptcy, whatever it is, what are my rights? What am I going to get out of the investment that I have done? So there are 3 or 4 examples that I have, they're a lot common here that I have stated. And I always go for number 1, 1x liquidation, fully participating. That's what I have done, and we'll talk about that. So what does all this mean, right? And I didn't know how to put it in a slide, so I apologize if it's very cryptic. And hopefully I can explain. So no liquidation preference. What does that mean? Means that if I own 50% of the company, and if the company gets sold, if I owned 50, if I invested in a company $5 million, and that represents 50% of the total value, I'm investing 50% at a 5 million. If the company tomorrow sells for $10 million, I'm not gained or I'm not lost. I'm going to get my 50% back because I have no liquidation preference. Whatever I put in, I get back 50%. If the company sells for $5 million, it loses value from 10 million to 5 million. I'm going to get 50% of $5 million. That is $2.5 million. If the company goes to $50 million, I'm going to get 50% of $50 million as an investor, assuming that there was no other investors coming in the round, and I'm not, this is what I own of the company, right? So no liquidation preference means that it is directly correlated with the percentage of the company I own. Okay, all right. The next one is 1x liquidation and fully participating. Fully participating, what it means is that I am going to participate fully in the gain, not loss, but gain. So let's do the same example. If I own 50% of the company and I invested $5 million, right? If the company gets, company sells for $10 million, equal to what I invested in, same valuation, I get $5 million plus 50% of the remaining. So I get $7.5 million. If the company is it gets sold at $5 million, my 1x takes priority over founders' percentage or the other people, the common stock, they invest for 50%. So I get full $5 million and founders get nothing. If the company sells for $50 million, I get my 5 million, 1x, right? 5 million plus 50% of $45 million. So there's 22.5 million plus 5 million. So as an investor, I make 27.5 million, and then the rest goes to the founder. Is that clear? Okay. You could also have 2x liquidation preference and non-participating, right? So again, the same example, I have 50% of the company and I've invested $5 million. I am, and the value of the company is 10 million. If it sells for 10 million, I get 2x liquidation. That means I get 10 million and the founders get nothing. If the company sells at 5 million loss, right? I can get up to 2x. In this case, I'm not going to get 2x. I'm just going to get 1x, $5 million, because that's the maximum I can get. But if the company sells for $50 million, the company sells for $50 million, I get my 2x liquidation, which is 10 million, plus 50% of $40 million, which is 20 million. So I get 30 million. And the reason I stayed percent if greater than 2x. So let's say the company doesn't sell for 50 million. The company sells for 20 million. I get 2x or let's say 30 million, because 2x would be equal. $30 million. If the company sells for $30 million, my 2x is 10 million, but my 50% is 15 million. So I get higher of the two. So one thing I want you guys to remember here is the liquidation preference is not to limit my gain as an investor, but it is to limit my downside protection. So give me some downside protection. So it only kicks in when I am making, when it's necessary, when I'm either making less than the liquidation preference that I have. So we'll go to the third example and then we'll just breathe a little bit so we can ask questions. 1x.
Go back to the 2x liquidation non-participating. When you shared the example of the 50 million exit, wouldn't this fully, if it was participating, wouldn't it then be the 10 plus 50% of 40 million? But
yes.
Why would in that case, here when it says non-participating, you said that would still count in for the 50% of the remaining? I don't quite understand.
Okay, no, you caught me, Christy, thank you. So yes, so what I was trying to say there is that if the company sold for $50 million, right? So my gain would be 2x plus the percentage, 2x, even I'm getting caught up in this. So hold on one second, let me get my thought around this.
Well, isn't it then capped at 2x?
No, it's not capped at 2x because you're also, I think you still get, so 2x or the 50, okay, yes. So it is either 2x or the percentage, whichever one is greater.
Right, yeah, but it's not both.
It's
That-
not both.
That would
You're
be
right.
participating.
Right. It's not both. It's whichever one is greater.
Yeah, yeah.
Okay. Thank you for catching that. Sorry. So 1x participation capped at 2x, right? So you could have 1x, but not to go over 2x. So the same example, 50% I own the company, $5 million I invested. I am going to get my first 1x, but I'm going to get the 50%, but not to go over the 2x as total. Okay. If I gain, then I get 1x plus 2x, but not more than that. So 1x I'm getting for sure, but my participation is capped at 2x. So in the case $50 million, I sold the company, you know, the company gets sold. 1x is 5 million, and my 2x after that is 10 million. So I'm getting 15 million, and the founders are getting 35 million. All right, we'll stop there. Questions?
The seed stage, I've only done Series A, B, and beyond. I didn't do, we didn't, for my own company, we didn't do a seed. But my impression was that it never got this complicated for the seed, because the more complicated it was, the further down the line, these investors weren't going to be that excited. So I'm just curious to know, how likely is it that you could get something like 2x liquidation
So
participating?
yeah, so these are the terms that I have seen personally in my note. Some of them I was able to negotiate, some not. But, you know, and also it depends on which company, how popular their technology or whatever they're creating is. And then the terms vary. Sometimes they'll also just get no liquidation preference if the company is really you know, popular and, you know, is growing like crazy. What has been your experience when you say Series A, B, C? Are you saying that you haven't seen any liquidation preference in your term sheets?
There was, but higher up we went. And I think it was at, you know, starting, it was A and B. And even there were limits on the liquidation preferences because we were cognizant not to make it more difficult down the line.
Can you say more about that? Why would it be difficult?
Oh God, I'm trying to recreate. I mean, it was so long ago. Well, if our Series A had really aggressive liquidation preferences, that would have made it less attractive for our Series B and C investors, is my assumption. And I think that's how we operated, but don't hold me to that.
So I have seen the terms don't change for the first, you know, especially for Series A or Series B as much. It's when the big VC money comes in, that's when the terms change. And that's when also a lot of the angels decide to liquidate their interest and move on, because then it doesn't make sense. So for example, one company that I know of, the VCs come in, and this is a new founders. This happened actually 10 years ago. VCs came in, and the company was really good. He had already raised money. This was right after our, you know, financial meltdown. So the money was very scarce, and he was so passionate about the technology. He got the money, he built the money, and the VCs came in, he gave them the term sheet. They were friends of his, and he trusted them. And the VCs put 3x liquidation before anybody. Few years down the road, the company was doing good. Then the 3x liquidation came in, and then owner, the company sold for 500 million, and the founders got not even 10 million. That was really sad, because they had this awful 3x liquidation preference.
Yeah.
So, and I know that, the person actually went into huge depression and, all that stuff. But, I think things have changed. Founders are much, much smarter now, and there's a lot of resources available. That time when he, his company got acquired in 2013, it was literally a vulture play. Like literally he didn't get much out. So yeah, so pay attention to the liquidation preference, because the angels also get screwed sometimes.
Right.
Big
Right. That's
VCs.
why I thought when you're showing these, I was wondering, do angels even get these sorts of things? I didn't think they did.
No, angels get, I always get 1x liquidation and fully participating. I try to get that. I shouldn't say I always get that, right? That is, to me, it's more common. The others, probably not.
I think it could be interesting if anyone's looking at any deals right now where this is a negotiating point. It would, if people are willing to do it. I don't have anything on my plate right now where we're discussing liquidation preferences, but it would be great either to look at something now to be able to be helpful to somebody that's trying to negotiate it now, or if you're able to maybe during office hours to walk through a real example of a past investment, so we could see what how you were able to get the liquidation preference, how it kind of turned out, like a real tangible example could be
we could
helpful.
do that. That's a great idea, Angel. If anybody has a term sheet they're looking at, they can they can black out the name of the company, whatever. We can just look at it as an example, or I can try to pull one from my deals and see if there is a good example.
I think it would be really helpful for me. I think in numbers, and I know not everybody does, but if we could put a model together that shows all these situations, from the liquidation preferences to the dilution to the money valuation, put pre and post money valuations, that kind of stuff.
Yeah, who was speaking? I'm sorry, I'm having
It's Katie.
Katie. Okay, hi, Katie.
Hi.
Yeah, sure. I saw Christy's daughter, so I was smiling. I'm like, Christy's daughter is not talking. I was trying to figure it out.
Way cuter than me, that's for sure.
Yes, Katie, that's a good idea. We will work on that. Kate, can we make a note of that? Because we will need, that's actually a great, I would love to see that too. So we could definitely.
I'm good with the spreadsheet. If it was helpful for me to be involved in building it, I can do that. I need you guys to help make sure it's all right and good and all that.
Yeah, let's do it. Let's do that together. Let me, let's talk offline, me, you, and Kate, and then we can figure it out.
Sounds good.
Yeah,
Okay.
and Katie, we probably have access to something pretty close as well. So, because I'm always one to not reinvent wheels if we have things that are already built. Unless, although I will say that the exercise of going through building that is a valuable one if that's one that you did want to engage in. But we could probably find one pretty close. to that and then do our own little tweaking with it, which might be a great exercise as a group.
Sounds good to me.
All right. So that's the thing for, everything I've covered is in term sheets. From an investor perspective, I know we have a guest speaker joining in today. So I'm going to, sorry, Kate.
And she's here, Jags.
She's here?
Yep, we've got her.
Okay.
Yep.
Do I have 5 minutes to just tell them what?
You do.
Okay. And
Yep.
again, what I'm about to share with you, show you is it's very hard to get from early stage founders. So I'm not saying that you're always going to get this, but I think it's very important that you always ask or even be curious about it, that if they have it or not. So the 3 statements I always look at are the income statement. Do they even know what that is and what does that include, right? So basically income statement, it shows business performance on monthly basis. I want to know if you are keeping tab on what's happening in your little world in terms of, your revenue, your expense, your profit, or, whatever it is. Again, most pre-revenue company may not have it, but I always ask, or I always even phrase a question like when do you think it would be a right time for you to have an income statement that shows all this things? And I just want to know what they're thinking, right? Like part of the due diligence is to get to know how founder thinks and how do they approach keeping a pulse on the entire business, because you want to make sure that they understand that the numbers matter a lot. So I have an example of this. This is what it looks like: historical period, forecast period, earnings before tax and net earnings. And, these are pretty common things that they can just put it together. And once they put it together and they share it with me, then I have a baseline to go further into, like, how did you come up with this number? What are your thoughts on this? What needs to improve for you to have a greater margin, et cetera, et cetera. The second is a cash flow: starting cash, incoming cash, outgoing cash, ending cash, right? Cash shows actual time when, this activity is happening, because cash flow is extremely important. I know so many founders that they're so focused on building the product and the technology that they don't take time to understand these statements. If they don't take the time to understand the statements earlier on, my theory is that they are not going to have time later on. So I want to see if they've already thought about it and what their theory is on, starting to build this early on. Example of a cash flow statement, balance sheet, right? What are your assets? What are your liabilities? And who is, who are the shareholders? At any one point, you should be able to see that this is the same example that we saw earlier, a similar example. But these are the stuff that I kind of talk about. You guys can read this. I think we have a guest speaker and we can go over this next time if you guys have any questions. But these are some of the things that I see founders making, mistake.
Great.
Okay.
Thanks, Jags. I know also that was this is a dense topic area, and so I'm assuming everybody made notes. Let us know if there were some of these, any particulars, definitions, didn't understand this little one particular. Let us know where your holes were on this, and we can spend a little bit of time with you on those items. And we're happy to schedule like an additional office hour, whatever you kind of need for that. But without further ado, and yes, Kirsty's wondering if we'll share the deck. Yes, we will share the deck from Tuesday and Thursday, as well as the recordings from both sessions. We'll share those tomorrow. So, but without further ado, I'd love to bring Megan forward. Megan, I know you're in here somewhere.
Hi, how's it going?
Hello, Megan. How are you?
Good, excited to join. That
And,
was like some dense financial topics that were
Good. Yeah, you jumped in right at the crux of it all. Everybody, I'm delighted to have Megan Ananian here. And Megan, did I pronounce your last name right?
yes, Ananian,
Ananian?
whatever.
Oh,
Yeah, you got it.
perfect. Yeah, I like to do it right. I have one of those last names that looks easy, but 97% of people pronounce it wrong. So I like to just make sure I'm in that arena.
I hear you.
So fantastic. So Megan, I'm going to actually use our conversation to introduce yourself quickly. So Megan is just off of a great stint at Seed Invest, where she looked at probably a hell of a lot of term sheets. And so I want to can you go quickly over your background and most especially kind of what some of your focus areas were at Seed Invest?
Yeah, absolutely. Quick level is I studied accounting in undergrad, did investment banking at Wells Fargo Securities for 6 years on the debt side. So it was completely new to equity. And then I got my MBA at Yale, joined the Seed Invest team in New York, and spent about a year and a half investing generalist across industries, mostly at the seed stage, some Series A, some pre-seed. And now I am actually joining another fund, a female-focused fund, Kate, just so we'll be working together quite a bit. So I will be GP of the Helm here in New York.
Oh my God, that's fantastic. This is news,
Congratulations.
everybody. I spoke to Megan. Yep. I spoke to Megan a couple weeks ago, and that was, I'm so pleased. That is awesome. Can't wait. Okay.
Thank you.
That's great. Okay. So let's chat a little bit about term sheets. That was the bulk of the topic. And then there at the end, I do want to spend a little time on the financial statements, how it goes into everything. One of the topics we hit earlier in the conversation was around the different term sheets we all have thrown in front of us. We've got convertible notes, safe, priced round. Can you talk a little bit about actually, Megan, let me step one step back, and in your role at Seed Invest, because that's not exactly VC funding. Tell the group a little bit about some of the terms and some of the types of financing and the rounds that you actually dealt with at Seed Invest.
Yeah.
Just to position people.
So Seed Invest is a little bit unique that it is a fund and an investment platform, but the fund only evaluates opportunities that go on the investment platform, meaning people like yourselves could go on to seedinvest.com, look at opportunities and decide to invest. If you're an accredited investor, great. All opportunities are open to you, but then there are quite a few that are also open to non-accredited investors. So we kind of had an additional hurdle of, does this not only have to be a good enough investment for, a fund, but could a normal person digest this, understand it? Is it safe? So that's kind of the high level overview, but we mostly focused on preferred equity and convertible notes. Y Combinator has done a safe note that is more modernized and better, but I always approach safes with a lot of caution because sometimes they're just there's a lot of vagueness in how they're treated and if they will convert in the future to equity.
Interesting. So I was just going to ask you what some of your favorites or least favorites were in kind of this set of terms that people might look at. So why don't we address that
Yeah.
while you're talking about it?
So I have always gravitated towards preferred equity. You're investing right in the company, you're getting equity. There are tax benefits, frankly, for funds to invest directly in preferred equity. So I think it's the cleanest. For some reason, people hesitate. They don't want to put a price on a round. So most companies I see early on are doing convertible notes, and it's not until you're probably a year or two into operations, you've hit some kind of external signal to get to a priced round. But I'm hoping that that's starting to change a little bit. Convertible notes are also great, but I find that founders aren't always as educated as they should be on what it means to have a convertible note. It means in 2 years, it will convert to equity. So essentially, convertible notes are safer for an investor because it's debt. It has an interest rate, and worst case scenario, if this company does not have an equity round, then you can just get paid back as debt, and that's more senior than equity holders. However, in my experience, I see that a lot of convertible notes, they have these 1 to 2 year maturities, and then they keep just getting extended. And then founders are like, what? This could convert to debt? I may have to pay this interest? That's scary. So I think they can be done, if they're done well and they have all the right protections in it, they're a great way if people are a little hesitant to put a price on a round. But I would just make sure that the founder understands that it is a debt product. And so you get paid back before the founder gets paid back.
Megan, that's great. You're making me think, because one of the things I've seen definitely post-COVID, where especially founders who were fundraising as COVID hit, or had been planning a fundraising round fairly close to that time period.
Yep.
And everyone kind of had to shift their thought process. I saw a real increase in convertible note rounds. And
yes.
the way that I heard, and the way that I heard them talked about, the term bridge round, kind of the term like stopgap, this like, let me get 6 to 9 months down the road type of thing. What are your feelings around that as a tactic, especially as it relates to investors?
Yeah. So I did a lot of bridge rounds this past year. I think 2020 is a huge exception. There's incredible founders that were just getting to a certain point, and then they had the rug swept out from under them. So I think there are certain, all investing to me comes down to the people. Like, yes, I always ask for all the financials that were mentioned. And I even look through your bank statements. I want to go dig deep and understand how you are running the finances of the company. But ultimately, what it comes down to, what I'm trying to figure out is, are you the right person to be captaining the ship? And in a time like this, when all the macroeconomic events changed, I was betting on the founders that I'm like, they just need 6, 9, 12, who knows? Hopefully it's not that much longer than 12 months, additional runway to get there.
For all of us.
A really safe way to do it. And because priced rounds, they do require a little bit more legal hurdles. You have to be incorporated as a Delaware C Corp for the most part. And so a lot of companies are just like, 2020, can't do all that right now. Let's just do this convertible note. And it's like, fine, that makes sense. I think they're great solutions if you are planning for, be very cognizant of what that maturity date is, whether it's 12, 18, 24. I don't think I've ever seen anything longer than 24 months of like, what are you getting to? What are your milestones that you need to get to for that to convert?
Great. You mentioned safe. when you were first running through a few items, and a little bit of hesitation. I heard from you. Can you talk through that? And again, especially from an investor standpoint, what does SAFE feel like for you?
Right. So safes used to be these, I forget what all the words stand for, but something for future equity. It's like you are committing
Yep.
to equity in the future, but
Simple agreement.
yeah, simple agreement. That's exactly it. We can't determine the price right now. We don't know exactly when it's going to happen. And they're great for founders because it's just an investor saying, I'm going to commit my money. I don't really know what's going to happen in the future. Historically, a lot of them were uncapped. They didn't have a valuation cap. They didn't have interest rates. They didn't have those conversions like in 2 years, this must happen or I get paid back. Y Combinator the year before, came out with a more modernized version that has most of the things that you see in a convertible note. So they're almost indifferent. So if a founder is using that version, we feel comfortable with it. It's just there have to be certain terms in it. A term that I look at all the time, it is probably the first thing I look at in a convertible note term sheet. Obviously, valuation cap and discount are most important. And then also I look at qualified equity financing threshold. That determines when your debt is going to convert into equity. And so if that's not there, then it's not really clear when it's going to convert. So the most standard for the industry, most of what I see is $1 million qualified equity financing threshold. All that means is the next time you go out and raise a round, as long as you raise at least $1 million in equity, then my note is going to convert with the rest of the equity. And that makes me feel really comfortable, right? Like there is a goal in mind that you have that next time you raise $1 million, I'm going to convert with those people. Some red flags I see are like a $3 million or a $5 million. Those are pretty big rounds, right? So depending on what happens, they might not raise around that size or raise like a couple $1 million rounds. And so when I see a really high QEF, I get a little bit nervous unless there's a specific reason they're
Megan,
doing
can
it.
I ask a question on that? Because we just went over this. So let's say that they're raising $1 million, right? And my convertible note cap is at $5 million cap. And when they're raising that $1 million, do they usually give the same terms, right? It's on the same note that they're raising, correct? Same terms. As long as
No.
they're not converting into the priced equity.
So you mean like, so the QEF is for an equity round. So it must be equity.
Okay.
So
they're going on the equity round, right? So
right.
$1 million. So that means, let's say that I have a company that I invested in $5 million cap, right? And they are $1 million at least
Yes.
raising. So that's like about 20% of the priced round, right?
Right.
So that means it's $5 million, right? So how does the math work there, if you don't mind?
You mean like what is the price of you
Yeah,
as
so
a shareholder?
am I raising? So basically what it's telling me that I am, the next round is raising at the same valuation as my note.
Oh, I see. I see that all the time, honestly,
You do?
because
Okay.
valuation caps are arbitrary.
Okay.
I usually see them like 3 to 7 million, maybe. And so that just means, and that's the cap. So that just means that as long as the valuation can't be higher than that.
Right.
And so I see all the time companies, especially this year, Kate, as you were mentioning, a convertible note round where you're just going at the same cap as your last round, or they're shooting for an equity round. Like they had a $5 million cap and now they're going for a $5 million price round. The cap was just like, this isn't worth more than this is the ceiling. And then the equity round is like, this is exactly what it is. And the people that invested in the convertible note actually get a 20% discount to that $5 million priced round.
But I think the ideal situation is the price round is higher than
Oh,
the
yes.
convertible, right? So the cap on the convertible note means that it kind of protects the convertible note investors that if it goes higher, I am not going to get my shares converted at a higher rate cap. My shares are going to get converted at the $5 million cap.
Yes, yes, exactly. And Kate, to your point earlier, a lot of what I was seeing this year for the convertible note rounds was people wanting to do a priced round, but they weren't sure if they were going to be able to hit that $1 million. And so then they're like, if we're not going to hit the $1 million and we're not going to be able to convert our notes, then we might as well just do another convertible note until things clear up and we can raise a big round.
Yeah, exactly. I mean, and to that point too, the additional, so feeling like, okay, I don't think I can raise $1.5 million as originally projected, but if I could get a 50K in to get me through this 2020 apocalypse stuff, like that was kind of exactly it. So great.
I have a quick
so Megan, you alluded to it. Yeah. Kirsty, go ahead. Yeah.
Okay. So, you know, often like, you know, each round is designed so that it is to cover the, you know, whatever time period is needed to reach the next milestone. So when it happens so that like there's like two notes back to back and the first one reaches the maturity date by or around the time, what happens to the first note? Like, does it kind of like, do they just extend it with the same terms, or does it sometimes happen that, you know, they somehow merge them or change the terms like to match the whatever the second note is?
I typically see them just get extended, and there's nothing wrong with that. I mean, it happens all the time. I think people used to think they just have a one year timing and then they'd get to the next milestone. So I don't want to scare you away from them. What I get nervous about is when there are several and they've all been extended. Like I see you still have them from 2016, you're extending them again, and they're all at different valuation caps and discount rates. And at that point, the founder really doesn't know what's going to happen to his dilution, his or her dilution, before they actually convert. And so I just get worried that there's too much complication there. But I think you can certainly, I mean, Seed Invest as an investor, when there's been a really messy cap table, we have asked friendly investors to repaper them all onto the same terms. So it certainly can happen. Like, especially if you have an institutional or something like that, that's like, we will draft all the documents. All you have to do is sign them and we'll make it clean and easy for everybody.
Yeah.
Great. And also this period of time is open for questions if anybody else has anybody, so please do chime in. Megan, a quick thing, if you were to look across the board, or maybe by term sheet that we've kind of been talking about, you've mentioned a couple of things that you definitely look for. So you mentioned definitely valuation, discount, QEF, that type of thing. As an angel investor and you're going into these rounds, you're not going to be writing the largest check. So you're kind of just coming into a round. What are some of the things that people should be thinking about when they've got a term sheet just in front of them?
Oh, that's a tough question. So like you don't have enough leverage to really push terms.
Yep.
I would say, so Seed Invest is usually the first institutional or fund investor after a bunch of angels have invested. And I very commonly saw kind of vague commitments with like we will invest as soon as the institutional sets the terms, like within this range. We're comfortable with $3 to $5 million valuation. And Seed Invest even did this too to founders, because I don't think that we're gonna, price isn't gonna, if we love a founder, we're not gonna not invest in a deal for something silly like 10 to 20% price. But we'll usually say, hey, I think you should price this at 5 million and you'd be able to close this round pretty quickly. And I think all of those investors who told you that they were going to invest are going to invest. If you shoot for 7, this might take you a while. And I think people might hesitate. And if people hesitate, you might lose people. And so I think as an angel, you'd look for some of those things, like a little bit of a range, but it's tough. It's tough because you're looking for some kind of external signal, some kind of validation that you can, whoever has priced it, whoever gave them the term sheet knows what they're doing, or you know what you're doing enough. I'd say the biggest secret that I didn't realize until I got into this business is there is absolutely zero magic to valuations. Everyone's making it up. I would say it's 3 to 7 million for a seed stage company. If you are incredible and you got Andreessen Horowitz to write his own personal money in there, maybe you're at 10. But aside from that, it's just like, that's it. So it's a really small range. So you can also, there like aren't really good public comps. If you ask a founder, they're just like, yeah, I think we're worth 20 million. And you're like, great, but that might hurt you in the future when you try to raise your next round.
What I have noticed, Megan, is over the period last decade, right, 2010, right after the financial meltdown till now, the valuation is increasing, at least 10 to 20% every year by because there's a lot more early stage money that, for example, Andreessen Horowitz, Sequoia didn't have the early stage funds before. Now there's so much early stage capital coming in. So even founders are elevating their valuation a little bit based on that. And if it's a good founder, like you say, there's zero magic.
Right.
This good founder is going to be able to attract more towards $7 million range than the first time founder with not that much reputation or credibility, 3 million. Also, then the other thing is geographical location. And it's just so it's like picking up thin air. Oh,
Yeah.
I think this is what your company is worth.
Yep. When my first day at Seed Invest, I was like, oh, I'm in the doors. Can you guys share with me the valuation model? I want to start like playing around with it and seeing what it looks like. And they were like, what valuation
You make
model?
one for us?
Yeah.
It's your job
Exactly.
description.
And I was like, oh, okay. You're making it up as you go. Cool.
Megan, do you have a range for
So that's actually,
post seed,
Nope, go ahead.
pre-seed?
Yeah. So the tough thing about post seed is it really depends on how much you're raising. Usually the target is about 20% dilution of the company. So say you're raising 5 million, then you should probably be raising like a $25 million round. And so that factors much more in versus 1 million, you could just raise a $5 million round, right? So that plays into it much more. And then I think the other thing post seed is at the seed stage, this is like getting to be a much wider spectrum than it used to be. But seed stage used to be like you've just started you maybe have a couple customers, maybe one big logo customer, couple 100,000 in revenue per year, but you're still working on hitting that inflection point.
Mm-hmm.
And so there's just a lot unknown. And then really when I see companies getting to Series A, you have $1 million in revenue, you have some of those external signals. So there's a lot more financial analysis that you can do of like, okay, this is a CPG company and you have 20% margin. So usually for those companies, I see like, 3x revenue is your valuation. So there's just like a lot more numbers that can go in it. At the seed stage, it's just too early for that for the most part. Pre-seed, that's an amazing question that I don't really know the answer to. I would say I still see probably $2 to $5 million valuations. Yeah.
Yeah, we just had one in at like 1.5. So they're, yeah. But he pretty like totally pre-launch and that's so really like beginning portion of pre-seed. So.
Right.
Thanks.
Wonderful. Any other questions for Megan? Because I can throw a couple more at her, but I don't want to waste aerospace. Anybody?
Yeah, I do.
Hi, Angel.
Hi. Thank you for joining us.
Of course.
So I recently had I did a live stream with an old friend of mine, Per Jorgen Persson he's a GP at Northstone. He's based in New York. And some of the questions that came up from both investors and founders were, what do you consider founder-friendly terms?
Yeah.
So I'd love to hear your opinion on that. And, obviously it's
6 o'clock.
Kind of, dependent on the deals themselves, but if you could elaborate on your viewpoint on that.
That's an awesome question.
First of all, one of my favorite people in the world who helped me when I had no idea how to get into VC and what to do is a junior investor at Northstone. Her name is Michelle Nacuzzi. So
they
love
have
Northstone.
At Northstone, they have like 50-50 now, female.
They've done a great job.
And yeah, it's amazing.
What's the name of the fund? Sorry.
Northstone.
Oh, Northstone. Okay.
Founder-friendly terms, the first thing that comes to mind for me is liquidation preference. I always look for 1x liquidation preference. I think anything, if you are a late stage company and you're investing in Slack before they get acquired by Salesforce, maybe you're looking for different liquidation preferences. But for an early stage, anything through Series B really, and if you're looking for anything more than a 1x liquidation preference, there's something wrong. It just signals to me that there's something distressed. So I'd say that's kind of predatory in my opinion. Founder-friendly terms, loose maturity dates. Like I really like 24-month maturity dates on convertible loans. It's 12 months, like, gosh, 12 months is so short. You have no idea what's going to happen. A pandemic could happen. So that's the second thing that comes to mind.
All right. I like literally almost just spit out my water. I'm like, yeah, you're right. A pandemic.
Yeah.
A literal pandemic could happen in the span of 12 months.
Yep. I'd say, those are the two things that are just jumping out to me. I'd say on valuation caps, giving a little bit of wiggle room is generally good. And for price rounds, I like giving ranges. I think that's very founder friendly. Like I was saying in the beginning of saying, if you show me, like a lot of times they're going through this 3-month fundraising process or 6-month long fundraising process. And they're like, we just need this. And then we're going to close Coca-Cola. They're going to sign on the dotted line. And it's like, okay, if you sign Coca-Cola in the next 60 days, I'll give you this $7 million valuation. If you do not, then and I'm going to give you a term sheet for that contingent on it. So you can go out and shop to other investors and you can use this as leverage. But if you don't do that, then I'm coming back at a 5. So like giving them a little bit of wiggle room, but understanding it's contingent on something.
Megan, great. If anybody else has any questions, pop in. We're getting into the realm of kind of like financials, milestones, that type of thing. And I know we're going a couple minutes past, but Megan, can you talk a little bit about how you view and evaluate? And I'd love if you had a little bit more of a qualitative answer to this, just for the sake of the amount of time that we have.
Yeah.
How you look at financial statements and that sort of thing vis-a-vis the term sheets that you're looking at.
Yeah. So I'll tell you real quick what I asked for. I asked for, so also keep in mind, I'm a little bit further down the road from angel investing. Like we're at the first, for the most part, companies have raised 500,000 friends and family before they come to me, but I come from a finance background. So I want to see your last 2 years P&L in Excel. If you've only been around for a year, great, that's fine. I just want to see all the numbers in an Excel spreadsheet by month so I can see what is trending in any direction. I want to see what your monthly expenses are. And then I will say I never see cash flow statements for early stage companies. I want to see what your cash balance is, which is why I look at your bank statement and I use that to see what was your cash at the beginning of the month, what did you spend it on, and where did you end up? And I want to see that for the last 2 months. Bank statements are honestly my secret sauce because you can find out a lot from that. You can see if they're like using their money on lots of hotels and restaurants and wining and dining, which for some industries that's fine. Or you can find out if they're, pretty conservative with their funds and they're doing a good job of only paying for things that are adding to the bottom line of the business. I'd say balance sheet. The only thing I really look at here is, sorry, I have a 3-month-old puppy and he gets excited this time of night. Balance sheet, I'm just looking for cash and outstanding debt. Outstanding debt is a big secret that sometimes you look through the P&L for the last year, everything looks good, trending up, and then you're like, oh man, you have $2 million in debt. I'm glad that I asked for that. Cap table, I just want to see that it's pretty clean, and I want to see the terms like a convertible note ledger. What did everybody invest on in the past? I want to make sure there's not like 99 investors on there, but it's pretty simple. It's more of just, are things trending in a good direction? Can you walk me through it? And I want to see your next 12 months financials. Some people ask for like a 3 to 5 year financial model. That's great. If you can do that, sure. But that's just like a dream world. I have no idea what's going to happen in 3 to 5 years. And so I want to see what your next 12 months are, because I want to see worst case scenario. Do you know that you have enough money to get through that next 12 months? And best case scenario, this is how great revenue could be. And then beyond that, we'll figure it out.
Yeah, I love that, Megan. The one thing I would add too is, and yes, by the way, anybody who needs Jory by, anybody who needs to hop off, I know we're a bit past the hour, please feel free. We'll close up here in the next 2 to 3 minutes. One of the things too, when I'm looking at, I do a similar thing. I love the bank statement situation. I haven't quite gotten down to bank statement level except as an angel investor. But not necessarily the glaring, are you flying business class? Some of the things that I've also dove into are like, wow, you have 60% of your spend this month on digital, social advertising. for
Yeah.
instance. Like, talk me through that, right? And so those are some of the things, and you also have that earmarked for the next 12 months. So,
Right.
so let's talk about that. And I'll give everybody an example of like a failure on this part is, and I this was not an investment, but I was actually the CMO of a tech startup out of New York City a couple years ago. And because of my general startup knowledge, I'll put to this group a rhetorical question that I don't need an answer to. What CMO says to their company, I feel that you should lower my budget because the amount of money that you're spending on digital advertising is not beneficial to the bottom line of this company. Like, so those are the types of things too, that in a startup, when you don't have founders who are well-versed on some of these full marketing, whatever it may be, like those are the things that you can find out when you get into the nitty-gritty and start asking. It's like, where, like Megan, you mentioned the trends, like, okay, where are they spending exactly? Like that type of thing is really
Yeah.
interesting.
Yeah. If you
So
have $1 million in revenue, but your marketing budget has been, 1.1 million. So your cost of acquisition of your customers is way too expensive. It doesn't really show you anything.
yep. Great. Wonderful. Are there any last minute questions? I don't want to keep people too far past, and especially Megan, who's been gracious with her time today. I think we're okay. Wonderful. I think we're good. Megan, this is fantastic. Thank you so much. Congrats on your new position.
Thank
That's
you.
awesome.
Congrats.
And thank you, everybody else. And we'll include some of these resources in our follow-up email tomorrow.
All right. Bye.
Nice talking to you
Great.
guys. Have a good night.
Thanks, everybody.
Thanks.